Welcome to Iron Financial, where we forge stronger portfolios and cut through market weakness. I'm your lead analyst. Today, we are putting TransUnion directly under the microscope. Now, this company just dropped a Q4 earnings report that, on paper, looks like an absolute grand slam. I mean, they beat on revenue, they beat on earnings, but the stock, it just didn't care. It barely budged and even dipped into the red. And that right there is a classic market paradox. It's a situation that screams there's a deeper story here, a major conflict between a really strong past and what looks like an uncertain future. So our job today is simple. We're going to figure out if TransUnion's corporate structure is built on solid bedrock or if we're actually looking at a foundation that's riddled with cracks.
All right, so to get to the truth, we can't just glance at the building from the street. No, we have to conduct a full-blown structural inspection. Here's our plan. First, we'll examine that earnings paradox itself, why these great numbers were met with such weak knees from the market. Then we're going to look at the steel beams holding this company up. I'm talking about the powerhouse growth in the U.S. market. After that, though, we have to inspect the cracks in the global armor, because there are international segments showing some real stress fractures. From there, we'll decode their 2026 blueprint, that's management's guidance, to see what they're really planning for. And finally, we deliver the Iron Financial verdict. Is this a structural opportunity for your portfolio, or is it a value trap that's just waiting to crumble?
Okay, let's dive right into this. The central conflict here, you just can't ignore it. TransUnion delivered what can only be described as a blockbuster fourth quarter. Seriously, every key metric they put out should have acted like rocket fuel for the stock. We're talking about numbers that scream strength, that signal a company that is absolutely firing on all cylinders. And this wasn't some minor squeak-by-a-penny beat. It was a decisive victory over what Wall Street was expecting. So the immediate question that every single investor should be asking is, what gives? Why did the market just shrug its shoulders at such an impressive performance?
Whoa, hold on a second. This one slide, this right here, pretty much sums up the entire problem, doesn't it? You're telling me they knocked it completely out of the park in Q4, but the stock stumbled and dropped over 2%? That just doesn't add up. If the results were so good, if the engine is running that hot, then the price should reflect it. Simple as that. The only explanation is that the market sees something else, something lurking in the future that completely overshadows these backward-looking numbers. This isn't just a paradox, it's a huge warning sign. And frankly, it's the mystery we are here to solve.
Exactly. And to solve it, we drill down into the cold, hard facts. Let's start with earnings per share. The street was looking for $1.03. TransUnion came in and delivered $1.07. That's a nearly 4% beat. Now, that isn't just statistical noise. That is tangible proof of strong operational efficiency and profitability. It shows that they are converting their revenue into actual profit for shareholders way better than anyone predicted.
And you have to understand, this strength wasn't just some clever accounting trick to hit the earnings number. The top line, the revenue, was just as powerful. The consensus estimate for revenue was $1.13 billion. They came in at $1.17 billion. That is $40 million of extra revenue that the smartest analyst on Wall Street didn't even see coming. This tells you that the demand for what TransUnion sells, their credit data, their fraud prevention, their marketing solutions, is incredibly robust. They aren't just managing expenses to look good, they're actively growing the business.
And for me, the quality of that growth is what matters most. This wasn't growth that came from some flashy acquisition that just bolts on revenue. No, this was 12% organic, constant currency growth. What that means is the core underlying business is expanding at a double-digit pace all on its own. This is the gold standard of growth. It's the kind of number that signals a healthy, dynamic business with powerful demand for its existing products. In today's complex macro environment, 12% organic growth is a massive statement of fundamental strength.
Okay. I've seen the numbers. You've laid it out pretty clearly. Beat, and a double-digit organic beat. You've made a case that should have sent this stock absolutely soaring. So I'm going to ask the question that every single person watching this right now is thinking. If everything was so spectacular, why in the world did the stock fall? Why did the market see this beautiful, pristine report and decide to hit the sell button? This right here is where the hype meets reality. The numbers you've shown us are all in the rearview mirror. So what is...
And that is the absolute crucial point. The stock market is a forward-looking machine. It is always looking ahead. It prices stocks based not on where a company has been, but on where it believes that company is going. And this is precisely where the cracks in the foundation begin to show. TransUnion guided for full year 2026 adjusted earnings per share to be between $4.63 and $4.71. But Wall Street had built its models, its entire valuation, around a number closer to $4.86. That's not a small miss. It's a significant shortfall that forces analysts to lower their future estimates. On top of that, they guided for 8 to 9% revenue growth next year, which is a material slowdown from the 13% they just posted. So what happened is the market saw a phenomenal Q4 report, but it was immediately overshadowed by a forecast that signals a clear deceleration. The past was great, but the future, well, the future suddenly looks a lot less rosy. That's the entire conflict.
So, given that major disconnect, we need to understand the company's real underlying strength. Is this weak guidance a sign of a true structural weakness, or is it just management being cautious? To figure that out, we have to inspect the core of the business. And for TransUnion, the absolute bedrock, the main steel beams that are supporting this entire structure, is the U.S. market. This isn't just a part of their business, it's the engine room, it's the powerhouse that drives the entire enterprise forward. Let's dig into the numbers.
And the numbers here are absolutely staggering. On an organic, constant currency basis, so apples to apples, the U.S. market grew by 16%. 16%! Now look right next to it at the international business. It grew by a mere 2%. This chart tells a story of two completely different companies operating under one roof. The U.S. segment is a high-growth machine, absolutely crushing it. It is the primary load-bearing wall of the entire company and is doing all of the heavy lifting. Without this immense strength at home, the overall picture for TransUnion would look dramatically worse.
Okay, look, a 16% growth number is impressive, I'll definitely grant you that. But a single headline number can hide a lot of problems. Is this strength really broad-based, or is it all just coming from one specific area that might not be sustainable in the long run? We have to drill down deeper inside that US number. Where precisely is this growth coming from? Is it one big lucky contract, or is it healthy demand across the entire board? Because if that entire 16% is being propped up by a single hot segment, that's not a steel beam, that's a potential point of failure.
That is absolutely the right question to ask, and the data provides a very clear answer. The main engine inside that powerful U.S. market is the financial services segment. It grew an incredible 19% organically, pulling in over $423 million in just one quarter. This isn't some fluke. This shows massive, widespread demand from lenders in banking, consumer lending, and the auto sector. Lenders only pull this much credit data when they are actively looking to write new loans. This is a very strong signal of a solid economic foundation beneath TransUnion's biggest and most important market. And it's not alone. Emerging verticals also posted a very strong 16% growth, showing the strength is indeed broad.
So the U.S. foundation is solid steel. We've established that. It's performing at an elite level. But any good engineer, any good analyst knows that a structure is only as strong as all of its component parts. And when we turn our inspection to the international business, we start to see the problems. These aren't just minor blemishes on the surface, there are visible stress fractures appearing in their global armor. Remember, while the U.S. business was soaring at 16% growth, the entire international segment was practically stalling at just 2%. Let's get a closer look at what's going on here.
Stress fractures might be an understatement. I'm looking at this table and I'm seeing outright breaks in the foundation. Yeah, sure, Canada and the UK are posting respectable double-digit growth, but look at the rest of the world. Latin America is down 3%, Asia-Pacific is down a whopping 11%, and then there's India, supposed to be a key growth market for any global company, and it's shrinking by 4%. These aren't minor cracks in the paint. This looks like the foundation is actually crumbling in key strategic regions. These were supposed to be the future growth engines for the company, and right now they're either sputtering or going in reverse. Are these just temporary issues, or are they signs of a much deeper, more systemic problem with their entire international strategy?
Well, management's answer is that this is absolutely a short-term problem within a long-term growth story. And to understand their position, we should hear it directly from the top. On the earnings call, CEO Chris Cartwright addressed the India situation head-on. He said, and I'm quoting directly, "Longer term, India remains a unique opportunity for TransUnion, and we believe a healthy double-digit growth compounder. We are the market leader in the world's fastest-growing market." This is the classic executive response. Look past the current storm clouds and focus on the sunny horizon. They're telling investors the long-term thesis is still intact, even if the quarterly numbers don't show it right now.
And I have to call that out immediately. That statement from the CEO, it sounds great on a conference call, but it flies directly in the face of their own reported numbers. You can't stand up there and talk about being the leader in the world's fastest-growing market while simultaneously posting a report that shows your revenue in that exact market is shrinking by 4%. The two statements are in direct conflict with each other. So which is it? Is the Indian market itself not as strong as they claim, or is TransUnion, the supposed market leader, failing to capture any of that growth? Now on the call, they blamed a one-time disruption from a large public sector bank and some fintechs pulling back. But that excuse doesn't even begin to explain the 11% drop across Asia-Pacific. This disconnect between the story they're telling and the data they're reporting is a major red flag for me.
And that glaring disconnect brings us to what I believe is the most critical part of our entire analysis. We have to decode management's blueprint for the future, their 2026 guidance. This is where we determine if their forecast is built on prudent conservatism, like they claim, or if it's hiding a deeper, structural weakness that actually justifies the market's negative reaction. And to do that right, we need to peel back a few layers of financial complexity that I think many retail investors miss.
Okay, let's really dive into this, because this is a crucial detail that you have to understand. When TransUnion provides a mortgage credit report to a lender, they often have to include a FICO score. Now, FICO charges them a royalty for using the score, which TransUnion then passes directly through to their customer, the lender. This is the key point. That royalty payment shows up as revenue on TransUnion's income statement, but because it's a direct pass-through cost, it contributes exactly $0 to their bottom line profit. Think of it as empty calorie revenue. It makes the top line growth look bigger than it actually is, and it artificially suppresses their profit margin percentage. Without understanding this dynamic, you really can't properly analyze the company's true performance. And here's the proof in the pudding. Their headline guidance is for 8 to 9% organic growth. Okay, that sounds pretty good on its own. But look what happens when you strip out those empty calories from the FICO pass-through. The real underlying growth of TransUnion's own products and services is only projected to be 5 to 6%. That is a massive difference. It completely changes the story. It takes them from being a high-growth company to a mid-single-digit grower. This feels like the market is being shown one impressive number, while the real fundamental growth of the business is something much, much less impressive.
And to be fair, management has a counter-argument for that exact point. Their defense is that they have a well-established history of being deliberately conservative. CEO Chris Cartwright said it plainly on the call. As we have reminded the market, we start off with a prudently conservative guide at the beginning of the year. For the past 2 years, we've been able to beat and raise. So the bull case here is that this 5 to 6% real growth forecast isn't a sign of weakness. It's just the low bar they're setting for themselves, a bar that they fully intend to clear throughout the year.
And this isn't just them talking a big game. Their track record, which their CFO Todd Shello laid out perfectly, proves it. At the very start of 2025, they guided for 4.5 to 6% organic growth. Where did they actually end the year? At 9%. They didn't just beat their guidance, they completely blew it out of the water. And if you look at those ex-FICO numbers we just talked about, they guided for 2.5 to 4% and ended up delivering 8%. This is concrete historical evidence of their under-promise and over-deliver strategy. So the crucial point for any bull is that history strongly suggests their current conservative guide for 2026 has significant baked-in upside potential.
I see the history, I do, and the point is taken. But that saying exists for a reason. Past performance is not a guarantee of future results. They can call it prudently conservative, but I call it reacting to the data you have in front of you. Maybe they aren't just setting a low bar for fun this time. Maybe they're being conservative because they see the very real cracks that we already identified in their international business. Maybe they see the slowdown in India and Asia Pacific and know, for a fact, that they can't promise the moon to investors this year. The conservatism might not be a setup for a future beat. It might be a genuine reflection of the real risks they're facing around the globe.
And that right there is the final question that we absolutely must answer. We've examined the paradox, we've inspected the steel beams of the U.S. market, and we've put a very bright spotlight on the stress fractures in the international business. We've decoded the blueprint for 2026, so now it is time to weigh all of the evidence and deliver the final structural assessment for you, our Iron Financial viewers. Is this company a solid investment that's being unfairly punished for its own conservatism, or is it a teetering structure that the market is absolutely right to be cautious about?
So let's lay it all out, side by side. I'll take the bull case. The argument for solid bedrock here is compelling. First, you have a dominant, high-growth U.S. business acting as a powerful engine. Second, there's a clear, multi-year history of conservative guidance that leads to a predictable beat-and-raise cadence. Third, management is actively rewarding shareholders with a new $300 million buyback program and a dividend increase. Fourth, the balance sheet is getting stronger, with net leverage down to a very manageable 2.6 times. And finally, there's a massive potential upside from the adoption of VantageScore that isn't even included in their guidance. It's like a free call option on future growth. And I'll take the bear case, because the argument for a cracked foundation is just as real and cannot be ignored. First, you have undeniable weakness in actual revenue decline in key international growth markets like India and Asia Pacific. Second, their 2026 guidance objectively missed Wall Street expectations. That's not a narrative, that's a hard fact that triggered the stock drop. Third, we've proven that the headline revenue numbers are being inflated by those no-margin FICO royalties, making the real growth story significantly weaker.
And finally, you have a clear projection for slower growth in 2026 compared to the blockbuster end of 2025. You can't just ignore a clear deceleration like that.
Here at Iron Financial, after inspecting the entire structure, our verdict is clear. The U.S. business is the bedrock, and it is made of solid steel. It is performing at an elite level and shows no signs of slowing down. Now, the international business has cracks, and the bear case has merit. Those are very real risks. But the market has overreacted. It has taken the conservative guidance, which management has a proven history of beating, and it has combined it with that international weakness to price this company as if the entire structure is unsound. We believe the market is focusing far too much on the cracks and not nearly enough on the 16% growth coming from the solid bedrock in the U.S. Management's history of underpromising, combined with the sheer strength of its core domestic engine and shareholder-friendly capital returns, suggests that this disconnect between performance and perception is an opportunity. The foundation is solid, and the current price reflects a level of fear that we believe is unwarranted.
Quick disclaimer, everything I share is for entertainment and informational purposes only. I'm not a financial advisor, so please do your own research or talk to a professional before making any moves with your money.